So it's Simon Brown here. This evening we're looking at the Momentum portfolio update. We're looking at the 2016 7 returns, and then we're looking at the profits and so the new stocks for 2017-18. So updating the old one and then look to the new stocks for the year coming up in advance. I'm going to have to grab my data. It only comes live at 8 o'clock. I'll get that in a couple of minutes as soon as we start to give it a few minutes to land. Then we'll pull in the data and we will search through and pick up those stocks for the next year in the Momentum portfolio. Quick bit of the theory behind it, investment strategy that really looks to say that trends continue. And that typically trends continue longer than we ever think. And two examples of that would be Naspers and Capitec, which have both had a stellar 10 years. We could probably throw PSG and many others into it, EOH, etc. But our brain struggles with that concept that trends continue, and what we often find is that we exit trends far too early. And Momentum says, nope, give them time. Based on research out of London School of Business, Dimson, Marsh, and Stoughton from 1900 to 2009, they looked using the FTSE 100 stocks. They did longs and shorts. They rebalanced monthly. Their returns certainly beat the FTSE. Big issue was they didn't have costs, and with their rebalancing monthly, that certainly pushed costs up. So the costs would take some shine off that 15.3% per annum. How much? I mean, certainly a couple of percent, maybe. I mean, let's be onerous and say half, and we end up at 7.6, 7.7% versus a market of 4.2x divs at a percent there. The theory works, and it aims to buy the stocks that are moving on a purely basis that the stock is moving, not on any concern around the fundamentals or anything like that. It just says if a stock is moving, you want to own it. I'm going to come back to Dimson and these folks a little bit later, but for now we can park them there. Practically, we simply sort stocks by the last 12 months. We get a total return. We buy the winners. It's just that's what Momentum is. There's nothing more fancy to Momentum than buy those stocks for the last 12 months that get the best returning stocks over the previous 12 months. The issue is the duration that you want to do it. Do you do it 1 month as the London School of Economics people did? Do you do 3 months as the ABSA ETF used to? 12 months as we do, and 12 months that the ABSA ETF now does. And my view is it's 12 months. We'll come back to that in a bit. Buy the winners, hold for a year. We run a tax year, so 1 March to end of Feb. Hence, last hour of today, I was selling all of the shares that sat in my Momentum portfolio. And if one's trading it, one would enter tomorrow being 1st of March. We don't gear. Absolutely no gearing. We don't gear this portfolio. There's a lot of talk. I mean, this year, cut out the bag, we have a negative return. You gear your negative returns. Yeah, I know you gear your positive returns as well. But if you have a 2008 type scenario year, those negative returns are going to significantly hurt in a geared portfolio. And I funded it with 200,000 over 3 years in Jan 13, March 14, and March 15, in total putting in 200,000. All the returns are based on a unitized portfolio. So by the time we put 40,000 in and then 60,000, we got less units because the value of the units had gone up. Our bang for buck, therefore, had decreased. Changed methodology last year. In previous years, we've done a top 40 and a mid-cap portfolio. If I go even further back, I had done a top 40 portfolio. I've been running this in one way or another now since 2007 was my first year of having done it, which was just top 40, introduced mid-cap as well in more recent years, but now blended the two together. So rather than two separate portfolios, one blended portfolio, top 100 as a benchmark, and use that as the pool of stocks. In other words, rather than looking at two separate portfolios, one at the top 40 and one at the mid-cap, blend the two together. And the logic here, so back when I first started this and I just did the top 40, out of the 40 stocks, I bought the top 5. And that's great, but it adds serious concentration risk. Now, we can argue points around it and the like in Q&A, but in essence, we said, let's try and mitigate some of that risk. And the first year we did it, it worked spectacularly poorly, but we'll come to those numbers as well. We're aiming to beat a benchmark annually and over 3-year rolling. We will slip occasionally for annually, but we must never slip on a 3-year rolling. We must always beat a benchmark on a 3-year rolling. And quite frankly, we buy the top 15 out of those 100 stocks. We buy the 5 must be from top 40, 5 must be mid cap, and then the next best 5. In other words, we're forcing at least a third into the top 40, a third into the mid cap, and then the next best, whichever index they're potentially going to come from. So key points, merge those two portfolios, looking for a 3-year rolling beating of the benchmark, annual as well, 15 stocks, 5 from top 40, 5 from mid cap, and then the next 5 from that same pool of 100. Returns up to last year. I'm coming to this year's returns in a moment. We'd had fairly solid returns. We'd beaten the market with an exception here. We had beaten the market. A minus 5.1 is not fun. Benchmark minus 6.6. Technically, you take that as a winner, you were less behind. Short version was working. Mid-cap giving better results. It will in the good years. In poor years, obviously, it will struggle. And in fact, in poor years, it will get fairly taken to the cleaners if you're in the wrong space. So there's my 2016-17 returns. This is a screenshot from the live portfolio, 5 to 4 this afternoon. Short version, we're down. I'll come to the exact numbers in a moment. We're down 5.6%, but then we pick up some of the cash that sits there, which is dividends and nil paid letters. The key distinction this year from previous years, if we look at total movement, and we've got some killers, AngloGold, Brait, Goldfields, and Sibanye. We've got some decent winners, Sappi, Resilient, PSG, COP up 51, and the rest, all the negatives. So we've got some winners, but we've got some killer losers. Now, one of the key points is we don't action stop loss on this. And I'm going to talk about it in a bit more detail also coming up, but we don't action stop loss on it because the numbers didn't work. The numbers don't work. Stop loss doesn't help. What it'll do is you put a stop loss at whatever point. The stock goes down by that percentage. Let's say you put your stop loss at 20%. Stock is down 20%. And then starts to recover. Now, when I've back tested it, more often than not, a stock that was down by your stop loss would recover rather than lose some more. And the math didn't come through in the process. You're ungeared, you're selling in a year, you've got a stop loss in a sense of time. I've always had the caveat that if there was some major corporate issue, I could pull my golden card in a sense and exit a stock, but otherwise they stay for the period. Those stocks have all been sold, and this afternoon they were all exited. We ended up with just under 245,000 Rand. There is still some interest that will be due for February, but it'll be 30 or 50 Rand. So portfolio was down 5.2% after all costs. Top 40 up 0.7, mid cap up 14.2. If we blend those in half, we get a 7.5% return for the benchmark versus a minus 5.2% for the momentum portfolio, which frankly is a whipping. 12 points behind is a really bad return. It is going to happen. So typically my expectation and my usage of the portfolio, and if I go back to that screen quick, is you have a losing year every 1 out of 3 or 4 years. What caught us last year was the sudden rotation into resources, and we just happened to straddle that, and we bought them, and then the gold miners all went off the boil. That is going to happen. That is a factor of it. I'm not unhappy with, no, I am unhappy. I accept the reality that sometimes we have negative years. Question, who do I'm using? I use AmiBroker. I have set up my watch lists for top 40 and mid cap, and then I use investordata.co to supply my data. Mike down in Cape Town. So as I said, losing year, nothing fun about that. And it's less, the being negative doesn't bother me. What bothers me is being below the benchmarks. If we look back here, we were negative, but we beat it. Now, I know it's small solace, but the point is you want to be ahead of the market. I want to beat it every 3-year rolling. I want to beat it most years, and I'm happy if it's only 2 out of 3 or 3 out of 4. Then you get those overall returns. It's like a trader. You don't win every trade. It's just on balance of probability. This time, we didn't win the trade. End of story. So quick touch on stop loss. So this year, stop loss would have been great. Let's go back to these numbers here. There's certainly a couple of stocks where a stop loss would have significantly helped. Where are my percentages? Minus 30, minus 52, minus 44, minus 54, minus 17. Minus 17 is fine. There are a couple of biggies there. Even the minus 30 doesn't overly stress me. So I did the crunching and I say, what level of stop loss improves my returns? And that's simple, right? You say if you're below zero, sell it the second it goes below zero. But then a lot of the stocks you've got, you would still have exited. Understand what a stop loss is. And I didn't grab that chart. But let's randomly take one of these stocks that is modestly up. That one that's up 3.2, Mondi. At some point this year, Mondi would have been negative. Right, so Mondi is down. We exited at our stop loss, and we don't get that recovery. So let's say at some point Mondi had been down 5%. We exit. We don't get that 8.2% uplift. So the problem with your stop loss is it also then removes some of your positive trades during the course of the year. The point of momentum, as it always comes back to, is that momentum takes some courage in the sense that you've got to say this thing is perhaps expensive and has been moving for a while, but the point being is even on retraces, more times than not, it will continue. Stocks, indices, whatever they are, turn infrequently. Typically, they go higher or they go lower, and they will follow those trends for periods of time. Kumba went up for years and then went down for years and years and years. So there's a risk with stop losses. And even if we take a negative number of minus 16 on NEPI, at one point it was down minus 22. So if we had stopped at minus 20, we wouldn't have got the 4% uplift. Let's not kid ourselves. If we said minus 20 was our stop loss, we wouldn't have minus 52 on Brait, 100%. I run the numbers for this year, but I've also got to run it for the previous years as well, where this is the first time I've had stocks down 50%, never seen it before. If you run it for previous years, the only level that worked, if you take a stop loss at 40% down, you say when a stock hits 40% down, 40%, you bail it immediately the day it closes 40% down. I'm using end of day data. At that point, you improve the returns of this year and you do not change the returns of previous years. The issue then, of course, is are we retrofitting? And that's a call you have to make. I will continue to run without stop loss. So let's go and grab those stocks for this year. We should have that. That should have crunched. And for some reason, it goes back and has a quick look at August 2015. I have no idea why. And there's my top 40. We're going to do a quick review. So what we're simply going to do now is we're going to say up to the close of 28 Feb 2017, we're going to do yearly returns. We're going to filter on top 40 initially. And let's have a look-see. And those are the returns, top of the list being Anglo. Question coming through. Yeah, so Sibasisu is asking. So I don't withdraw the money. What I do every year is I sell the stocks. So this afternoon I sold the stocks I bought on 1st of March 2016, and tomorrow we go and buy the stocks that are for the 2017-18 selection. So there are my stocks. I want to do two things. I want to grab a quick screenshot so that I've got them there, and I also want to mark them down. So it is AGO, TBS, IMP, BVT,